Okay, let's dive in. Welcome, everyone. Today we are unpacking the Q3 2025 earnings call for Moody's Corporation, ticker MCO.
And this wasn't just a solid quarter. This was, frankly, a phenomenal record-setting performance for management.
Absolutely. Our mission today is to get past those big headlines. We want to distill what's really driving the key segments. That's Moody's Investor Service, or MIS, and Moody's Analytics, MA.
And track where the capital's going.
Exactly. But the real puzzle, and what we really need to solve for you, is this huge disconnect. The company puts up record numbers, raises guidance for the whole year.
And the stock just fizzles. It closed down a little bit by the end of the day.
It's a classic case of incredibly bullish fundamentals hitting a very, very cautious market.
Right. So if you just look at the Q3 results, the first thing that just jumps out is the sheer scale of it. Moody's broke a huge milestone.
$2 billion mark.
For the first time ever. They hit $2.01 billion in revenue, which is up 11% year over year.
But the revenue is only half the story, isn't it? It's how it drops to the bottom line.
Yeah. That's the real story. The operational leverage they got this quarter was, it was massive. Adjusted diluted EPS came in at $3.92.
That's a 22% jump year over year. And it beat the street's expectations by, 6%?
Handily beat them. And just for context, management pointed out they've more than doubled their adjusted EPS from the same quarter just 3 years ago.
Wow.
This is a business that is just peaking in its ability to turn revenue into actual profit.
And that all comes down to margin expansion. The group's adjusted operating margin expanded by 510 basis points. You just don't see that every day.
It's a huge number, settled at 52.9%.
Yeah.
And it was strong everywhere. MIS set its own all-time record, $1.1 billion, up 12%.
And MA wasn't a slouch either, $909 million, up 9%.
So the results were, fundamentally clean, rock solid. Yet the market just sort of shrugged.
Which means the reaction wasn't about execution. It had to be external macro fears, interest rates, geopolitics, something else spooking investors.
Exactly. The company itself is firing on all cylinders. And that's why we have to separate that market noise from what's actually happening inside the business.
Okay, so let's start with MIS. That macro caution clearly didn't hurt their results. The margin story there is just explosive.
It really is. MIS delivered an adjusted operating margin of 65.2%.
65%. And that was an expansion of 560 basis points year over year. That is just top-tier efficiency.
And it was a mix of things, right? Strong issuance activity, very tight credit spreads, but also really disciplined cost control.
So where did the actual activity come from?
The biggest bump was from leveraged finance.
Yep.
That was driven by huge investor demand and, a pretty big pickup in M&A activity.
Okay, so that pushed corporate finance transaction revenue up 13%.
Right. And we also saw bank loan revenue just surge up 29%.
Mm-hmm.
Now, we should probably note that was tempered a little bit by a lot of lower fee repricing activity.
Got it. Now let's talk about the big one, the refinancing wall. This feels like the core thesis for MCO for the next few years. What's the latest data telling us?
Just confirming the acceleration. Management's latest study shows that global refinancing needs over the next 4 years, they're now projected to be over $5 trillion.
$5 trillion.
That's a 10% compound annual growth rate just since 2018. This isn't a theory anymore. It's a huge, quantifiable wave of debt that is coming due.
And the type of debt in that wave is so important for MCO's bottom line. Spec grade is just more profitable for them than investment grade. Can you quantify why that mix matters so much?
Well, that's pretty simple. They just earn higher fees on speculative grade debt. There's more complexity, more surveillance involved. So the good news for them is that the mix is looking very favorable.
How favorable?
Investment grade maturities are up 5%, which is fine. But speculative grade maturities are up 7%. And here's the kicker. Within spec grade, just U.S. bond maturities are up more than 20%.
Okay, so that mix is a direct tailwind for future revenue. It's just more lucrative business coming their way.
A very lucrative backdrop for the medium term, yes.
We also have to talk about private credit. It's a narrative that gets, I think, really misunderstood. Revenue from it grew over 60% this quarter.
And deal counts were up almost 70%. But the key, and you have to get this, is what is driving that. It's mostly fund finance and securitization. It's not direct lending.
Which brings up a good question. Is this growth a sign of health? Or is it a sign that unrated private deals are feeling some stress and need to come into the rated public markets?
It seems to be more about arbitrage than stress right now. We're already seeing a steady flow of private deals coming back to the rated BSL market, the broadly syndicated loan market, to refinance.
And they're saving a lot of money doing it.
A material amount.
Yeah.
On average, 200 basis points.
Yeah.
Sometimes we're seeing as much as 400 basis points in savings compared to what they were paying in the private market.
So just to put that in context for everyone, you have unrated private companies who can save up to 4% on their annual interest payments just by getting a public rating.
Exactly. It confirms MCO's pricing power, and it effectively creates this sort of deferred maturity wall for the public markets. It's a really significant structural tailwind for them.
That's a huge dynamic. And looking ahead, it seems like M&A is building momentum too. Management mentioned a record quarter for their rating assessment service, or RAS. Why is that such a good leading indicator?
Because companies don't spend money on RAS unless they're pretty serious about a deal.
Right, you're not just kicking the tires at that point.
No. You're getting a preliminary non-public rating opinion because you're planning to finance something. A record quarter there tells you the M&A pipeline is genuinely robust and should be a real positive for them well into 2026.
Okay, let's pivot to the other side of the house. Moody's Analytics, or MA. This is the more durable, high-quality recurring revenue part of the business.
I mean, you can almost think of it as a utility asset. The annual recurring revenue, or ARR, is nearly $3.4 billion. That's up 8% organically.
And it's sticky revenue.
Very sticky. 93% of it is recurring, and they have retention rates that are always in the low to mid-90s. That durability is what underwrites the entire company, really.
And just like with MIS, the margin story here is impressive. Maybe even more so because it's ahead of schedule.
Way ahead of schedule. The MA adjusted operating margin hit 34.3%. That's a 400 basis point improvement from last year. And it puts them solidly on track for their medium-term goals. And they're doing it while also simplifying the business, like selling off their learning solutions unit.
That margin number is fantastic, but let me play devil's advocate. Does hitting a 34% margin mean they're maybe pulling back on investment? Are they choosing profitability today over growth tomorrow?
Management would say no. They insist they're maximizing investment, but just in very specific strategic areas.
Like where?
We saw really strong growth in their decision solutions unit. That's where banking, insurance, and the really crucial Know Your Customer, or KYC platform lives. Decision Solutions ARR grew 10%. But KYC is the real star. It's the fastest growing piece, hitting 16% ARR growth. So the capital is clearly flowing to where they have a real competitive advantage.
And that advantage is expanding beyond just finance. They mentioned new deals with a big tech company and a global social media platform.
Right, for things like fraud detection and compliance screening. It just shows you how valuable their proprietary data has become outside of their core banking customers.
And that data is their moat against all the AI fears, right?
It is. They were really clear about it. They have Orbis, which is this massive cleansed company database. You can't just scrape that from the web.
Right.
Then they have the really unique stuff, like data on politically exposed persons. It's funny, some of their best data assets came from post 9/11 compliance needs, like the RDC business they acquired.
To combat terrorist financing originally.
Exactly. And the secret sauce is linking all that data together to give insights on beneficial ownership that, a startup just can't replicate. It's a moat built on regulatory tailwinds.
And they're building new moats, too, like in climate risk. That deal with the Asian regulatory agency sounds like a huge precedent.
It is huge because it's the first time a regulator has bought Moody's climate solutions for its entire financial sector, all 11 banks and insurers.
So it sets a global benchmark. It could create a standard for mandated adoption everywhere else.
It positions them as the default provider for climate risk assessment. It's a massive first mover advantage.
And finally, on MA, their AI strategy seems to be moving from theory to actual revenue.
Yes, and these are not easy wins. They landed a $3 million deal with a Tier 1 U.S. bank.
To do what exactly?
To automate the creation of credit memos and deploy early warning systems for real estate risk. Now, the $3 million isn't the point.
Right.
The point is that their AI models are getting through these incredibly complex bank risk governance frameworks and actually working. It means the solutions are enterprise ready. That's a huge hurdle to clear.
So you take all this incredible execution, both in MIS and MA. What does it mean for the outlook? Management basically raised the bar everywhere.
For the second time this year. It just screams confidence. For the whole company, they're now guiding to high single-digit revenue growth and an adjusted operating margin around 51%.
And the EPS guide was a big jump.
Huge. The new range is $14.50 to $14.75. That implies about 17% growth at the midpoint, They also raised the guidance for both segments individually. MIS margin is now 64%, MA margin around 33%.
Yeah.
It's just a clear signal of conviction.
And they're using all that cash flow to reward shareholders. Free cash flow guidance is about $2.5 billion.
And they boosted the share buyback guidance. It's now at least $1.5 billion, up from $1.3 billion.
So they're on track to return over 85% of their free cash flow to shareholders. That's a powerful statement.
It is. And even while doing that, they're still making these long-term strategic bets, like the deal to acquire a majority stake in Maris, the top ratings agency in Egypt.
Management called that a generational investment.
It is. It's about capturing the 90% of emerging market debt that's still rated locally. It gives them a massive first-mover advantage across the Middle East and Africa.
And looking to 2026, they're already painting a pretty positive picture. More tailwinds than headwinds.
Yeah, they see tight spreads continuing. Maybe the Fed starts easing, a robust M&A pipeline, and these sort of deep currents like data center financing just continuing to drive debt demand.
Okay, now get to the part of our deep dive where we explore the divergence trade. This is purely for intellectual discussion based on what we've analyzed, and it is not financial advice.
And the thesis is pretty straightforward. You have a company that delivered one of its best quarters ever, raised guidance everywhere, and the stock went down.
So the market is completely ignoring the company's strength because of broader risk-off fears.
Exactly. So the challenge for you as an investor is to figure out how to bet on those powerful secular drivers, the refi wall, the KYC growth, that are just being overshadowed by short-term noise.
So we want a trade structure that capitalizes on that eventual recovery, but that sort of pays us to wait for the catalyst to actually happen over the next, say, 12 to 18 months.
Our proposal is a high-conviction trade that focuses on duration. We'd recommend initiating a long call spread with a far-out expiration, maybe Q3 2026. And you fund that by selling a short put spread on the current volatility.
Okay, let's break that down for everyone. What are we actually doing with that structure?
You're making a leverage bet on that delayed upside. For when M&A really comes back and that private credit refi wave hits the public market, that's the long call spread.
And we pay for that bet by selling the short put spread.
Exactly. You're basically selling insurance against a moderate drop in the stock price. You use the market's current high volatility to get paid, which funds your upside bet.
So you're creating a synthetic hedge while you wait for the company's great execution to finally get priced into the stock.
And you have that accelerating $1.5 billion buyback program acting as a nice floor underneath your short put position. It's a strong setup.
It's a very well-structured bet on patience and on the fundamentals eventually winning out. So, to wrap up our deep dive, MCO delivered a monster quarter, raised its guidance for the second time, and proved its strength across the board.
But the market's reaction just shows that broader economic skepticism is still the dominant force, at least for now.
So here is a final provocative thought for you to chew on. Given this renewed commitment to high single-digit growth in Moody's Analytics, but now with this significant margin expansion, they're guiding to 33%. Should investors stop thinking of MA as a high-growth disruptor and start viewing it more as an incredibly durable, high-margin utility that basically underwrites the cash flow for the entire company?
That's a great question because that really changes how you value the whole enterprise.
That's all for this deep dive. Thanks for listening.